Okay, let's go ahead and get this started. Welcome everyone, and thank you for joining me this evening for our second and last insurance recovery webinar. My name is Richard Villanueva. I am Vice President and a licensed public adjuster with the Greenspan Company, Adjusters International. For some quick background, the Greenspan Company is licensed directly by the Department of Insurance to act as an advocate on behalf of those who have lost their properties due to fire or earthquake or flood. We have been representing losses for the last 78 years, and we are the largest firm in Northern California, and we have been a major player in the recent wildfires in recent California history. So we bring a very different level of expertise. We have represented over 65,000 losses, and our hope is to share some of that knowledge with you this evening, and hopefully you walk away with a little something more. I'd also like to say I am not a professional speaker, so that I ask for your patience as we go along. The goal for this evening is to kind of cover several different topics, the policy, answer some questions, go into what a lot of you are experiencing now with your insurance adjusters, and just kind of give you a better understanding as to what to expect as you move forward in this process. With that, let's go ahead and start with some common misconceptions that we typically see here with wildfires. And this is with every single wildfire, folks. So this isn't unique to this one. I have a policy. I've paid my premiums. My policy limits are X, whatever is on your policy. This is what my insurance companies will pay me, right? That's a reasonable thought, folks. And when you look at your policy, you think that that's what your policy is going to cover. Now, for some of you, in all fairness, maybe some of you have had policy limits. If you have USAA or if you have a company called Horace Mann, it is quite possible that you have been paid policy limits. But for most of you who have State Farm or Farmers or Allstate or California Fair Plan, my guess is you have not received your policy limits, and that is why we have these webinars, so that you understand what it's going to take for you to get that. The misconception is that the insurance company, just by you having a policy, will pay what you see on the policy. That is not the case. It is your responsibility, folks, to prove to the insurance company the value of what you are owed. There is no statute in California that mandates that what the insurance company comes up with be accurate in their assessment. It is just simply their assessment of what they think they owe you. And we'll get into that a little bit later. The second misconception is my insurance is being really cooperative. They've already cut me some large advances, and they even put me in a new rental property. Folks, let's identify what that means. So in California, there is what is called the undisputed amount. And I'm sure that most of you, given the previous wildfires, have heard a lot of these insurance companies are taking quite a bit of heat for what they aren't paying their insureds. The problem is that because you are giving these or given these advances, you think your insurance company is cooperating with you, but it's not the case. They're obligated to give you payments within the first 30 days, and they're obligated to put you into housing based off your policy. If your insurance company folks were really being cooperative and they were really working with you, they would be cutting you checks for your policy limits. That's the reality of where you're at. The fact that they aren't should tell you exactly what they're doing. They're playing the same game they have every year for every single wildfire. And I don't see them changing this. And that's why we have to put these webinars on, which is to really help you better understand where you're at, where you need to go, and what it's going to take for you to get to the finish line. So with that, let's go ahead and just jump into some of the coverages, because this is, where a lot of confusion comes into play. Now, all of you basically have the same coverages. Some of you will have less coverages than others, given the type of policy that you have or who you're insured through. An example to that is some of the California Fair Plan policies do not have personal property coverage, and that forces you to then seek another policy just for your personal property. But we're going to just kind of talk in broad explanations here as to what these different coverages are, because they will apply to most of you. The dwelling is the stated limit that you see on your policy, typically referred to as coverage A. What you also want to know, folks, is if you have an extended replacement cost endorsement. Now, some policies do and some policies don't, and I'll briefly explain what that is. If your policy or your loss should exceed your stated limit as posted on your declarations page under coverage A, if you have an extended replacement cost endorsement, it will unlock a secondary bucket of money, which will then be available to you for your reconstruction. So the term you're looking for, folks, in your declarations page is extended replacement cost endorsement, and we'll get into that a little bit later. Personal property, there are two types of personal property coverages. One is ACV, which is actual cash value. The other is replacement cost. Majority of most policies are replacement cost for your personal property. We're going to definitely get into that because there is also a misconception as to what replacement cost means and what your recoverable depreciation means. And we'll get into that later as we get into your personal property. All of your policies should have, except again, for some California Fair Plan policies, other or separate structure coverage. That coverage is typically represented by a percentage of your dwelling, which is using a simple example. If you have 500,000 in dwelling coverage, typically your separate structures will be represented by 10% of that dwelling. Could be 50,000 in some cases. You may have a 20% extension, which could be 100,000, but it's on a case-by-case basis. Some of you will not have code upgrade coverage. Most of you will have code upgrade coverage, which we'll get into. Code upgrade is a use it or lose it bucket of money, and we're going to refer to these as buckets moving forward. It's just easier. And code means basically just that. When your home was built, back at the time it was built, the building codes were different than they are today. And so if there is an expense associated with a code-related item, for example, sprinklers that may need to be added to your home, maybe there is a solar or energy efficient code that needs to be adhered to, that additional cost is usually covered by your code-related coverage. ALE, which most of you are probably already familiar with and experiencing now, is your loss of use or your housing. And most policies are either defined by a dollar amount or an amount of time, which we'll get into a little bit later because some of that is still confusing for some of you. And of course, debris removal, which I'm sure you've all paid attention to, and your trees, plants, and shrubs, which we'll get into again. All right, let's get into coverage A because that can be a little confusing. And so we're going to try to break it down as best we can. When you have these types of events, folks, you have options. Some of these options are limited based off whether you have a mortgage or not. And we're going to kind of get into that. If you don't have a mortgage, you have 4 options. If you do have a mortgage, you have basically 2 options. If you don't have a mortgage, you can rebuild anywhere you can rebuild on site. You can rebuild anywhere else in the country. You cannot rebuild if you so chose, or you could purchase a replacement property. So for the sake of this example, we're going to use 3 examples: not rebuilding, purchase a replacement property, and rebuilding on site, because most people tend to take one of these 3. Rarely do we see people rebuilding off-site in another state. They typically will buy instead of rebuild. So we're just going to use $1 million as a base limit here and across the board. Debris represents 5% of your coverage A limit. It is in addition to, it's built into your coverage. However, if your loss exceeds the policy limit, it will take that 5% and it pushes it out into its own little bucket of money. And we're going to get into some debris removal because that's going to become quite a topic of discussion a little bit later. Your landscaping is 5% of your dwelling. So whatever your dwelling number is, you have 5% for trees, plants, and shrubs. Now, over the years with these wildfires, the insurance companies have learned quite a bit, and they start putting restrictions in their policies. And some of you You may want to read your language because it may state clearly that your trees, plants, and shrubs are planted trees, plants, and shrubs, and not natural landscaping. When you have these types of events in the rural areas, many of you have acreage. It might be 5 acres, 2 acres, 10 acres, doesn't matter. But typically in that acreage, there's quite a few trees. And so they realized this. And so they tried to then even narrow it even more so that they could try to save money. And then your extended replacement cost, again, depending on the type of policy that you have, will be represented potentially by different percentages. State Farm typically has 20%. There are coverages that apply 50%. There are coverages that double your policy, and I'll explain what that means. If you do not rebuild, folks, and you take the dollar that the insurance company offers you, that extension of coverage does not come into play because you're not performing, you're not rebuilding, and you're not replacing. You're taking that money. If your loss is not measured above your policy limit, which we'll get into, it will not unlock that secondary extension of coverage, and it will still not be available to you. And what we see in a lot of cases is that these insurance adjusters who come in from out of state, or these catastrophe adjusters, or these large loss adjusters from the different carriers, will write your estimate just under your policy limit by design so that they don't have to unlock that secondary extension of coverage, which, if you think about it, it's an additional liability to their employer. The difference between what we do and what the insurance company adjuster does is the insurance company adjuster, folks, represents the position of their employer, the insurance company. We are licensed to represent the position of our client, the insured. So it's critical to know how you are going to get your estimate or the value of your loss above your policy limit so that you do have access to your extended replacement cost endorsement, because it's going to be critical you have access to that should you rebuild or replace. But the reality is, in order for you to do rebuild or replace, you have to know what your budget is first. And that budget is really the settlement of your claim. If you rebuild on site, that extension of coverage comes into play. And if you have a 50% extension on $1 million policy, it will give you an additional $500,000. So if you have a $500,000 policy and you had a 50% extension, it would give you an additional $250,000 towards the rebuild or the replacement of a property. We'll get into that a little bit more, but that's the basics. You have an extended replacement cost coverage potentially. And how do you access that? Because that's a use it or lose it bucket. And just for clarity, what that statement means, folks, the most the insurance company will ever pay you as a check in your hand is the stated limit under coverage A. But again, that's if your loss has been proven and the valuation is what your policy limit states. If you haven't proven to the carrier that your loss exceeds your limit or is up to the limit, and you're allowing the insurance company to control your financial narrative, to simply put it, folks, your entire financial recovery is solely dependent on that one individual's interpretation of that 1 hour conversation that they had with you about what you had and what your home consisted of and the finishes and the fit. And so they're trying to recreate your entire home in a short conversation to come up with some kind of number so that they can apply their valuation and pay you what they believe they owe you. There are some cases that some policies do increase in policy coverage in the event of a declared catastrophe, which this as of yet has not been, from my understanding. But if that does happen, it is rare that these policies, there's only a handful of policies and carriers that actually offer this. But again, folks, your policy is not a policy. It is a contract. It is a contract between you and your insurance company, and you agreed to those terms when you submitted your premium, and they agreed to the terms when they accepted those premiums. And so you need to really understand how to navigate that contractual language, because if you don't understand how to read that policy or understand what their contractual obligations are to you, it is going to be difficult for you to hold them accountable for their position if they don't respond accordingly. And again, code is a use it or lose it bucket of money, folks. If it is something that is required and if you are performing, that code coverage will represent typically 10% of your policy. If you do not rebuild, you do not get your code coverage. It is only when you perform. If you replace a property, the code comes into play, which I'll explain a little bit later. And or if you rebuild on site, the code coverage comes into play as well. So we'll go into those as we get a little further down the line, so there's some clarity for you. Next coverage is your coverage B or other structures. This one can sometimes be a little confusing for some, so I like to provide a little bit more clarity. Other structures, folks, is exactly what you would think it is. Garages, workshops, detached garages, fencing, retaining walls, walkways, driveways, patios, sprinklers, exterior lighting, pools for some of you, and cabanas or even outdoor kitchens. Now, whatever your coverage is for your coverage B, it's typically a representation of coverage A, and it's represented by a percentage. So again, if we're using $1 million policy as your coverage A coverage for your dwelling, coverage B is typically 10 or 20% of that. So in this case, it's 10% of $1 million, which would be $100,000. Each one of your policies are different. So you want to look at your declarations page, which will define what your coverages are. Some policies will extend your replacement cost endorsement to your other structures. It is important to know, folks, if your policy extends your extension of coverage to your other structures, because as you go to rebuild, it's important to know what actual monies you have available to you so that you are maximizing your financial recovery. Debris removal is also included in other structures of 5%, and code upgrades is also included in your other structures of 10 to sometimes 100%, just depends on the policy. So other structures, as you picture your own property, can be basically any structure. If you took your home and you plucked it off the property, anything left remaining on the property typically falls under other structures. And if you have pools, that can become quite problematic because most people, and this is not any fault of yours, folks, but most agents and or brokers do not properly inform their clients. Again, no disrespect to any agents or brokers that might be joining us this evening, but this is the truth. If you have a large exterior separate structure, let's call it a shop, for lack of a better term, because some of you have large external separate structures that are not just garages. In most cases, you should have that insured as a separate scheduled line item with its own value. In most cases, though, from my experience and our experience, most wildfire losses, most people are underinsured in that particular coverage because you have multiple exterior structures, you have multiple shops or detached garages potentially, and you may even have a pool. If you have a pool, in most cases, that other structures is consumed just by way of what it would take to replace the pool and or a separate shop. So don't be surprised, folks, if you're underinsured in that particular coverage, unless your agent or broker advised you properly. Next, we're going to go into the personal property. Personal property is, I would say, the hardest, most time-consuming, life-sucking part of this entire process, folks, because of what the insurance company imposes upon you. And I'm going to make this really clear, folks. Every single thing the insurance company does, every question that they ask, every position that they put you in is by design, which is why the Department of Insurance has us in the private sector to balance that scale of power and knowledge and protect your interests. There is a reason that the insurance company has you do your own personal property, and we'll get into that. But your personal property is going to have a base limit, and that base limit is whatever you see under your coverage C in most cases for personal property. Most policies, folks, have sublimits. It's important for you to know what your sublimits are as you read the policy because you need to know what the carrier's position is on parts of your personal property. If you've had a baseball card collection, if you have collected monies, if you have a stamp collection, and there are a lot of different sublimits that are listed in your policy, you want to know what those are so you know how to navigate around those sublimits. You don't want to shoot yourself in the foot and put that product on your list thinking you have $100,000 baseball card collection and your policy has a sublimit of $2,500. So you've got to know what you're up against. And some of your policies will have what are called scheduled items. As I mentioned before, in your other structures, scheduled items for personal property applies in the same way. If you had a $100,000 baby grand piano that was 150 years old, and you have 300,000 in personal property coverage for your entire home, that one line item will consume over a third of your personal property coverage, and then you're going to have a lot of personal property that would not be covered under that coverage because that one line item would consume the majority of it. So what most agents and brokers should do is advise their clients for your very high end or very expensive line items that would consume a large portion of your personal property coverage. They should be insured independent of themselves so that they have their own value with their own line item, and that doesn't take away from your overall coverage. But in this particular case here, you're going to have a base limit of whatever your base limit is for your personal property. Sub limits, again, will apply to business personal property. That's important to know, folks. If you have a business and you're running your business out of your home and you have a home office, the policy doesn't pay for your business personal property. And if you had $50,000 or $60,000 worth of equipment that was business related and you only used it for your business and your home office, your policy may have a $5,000 sublimit. So it's important to know how to word your position with your personal property. Watercraft, cash, those are items that will also have sublimits typically. Scheduled items, as I mentioned before, would be, let's say, high-end jewelry potentially, or artwork, or particular products like furs as an example. We use that because it's come up in the past. Now, in many cases, folks, when there's a total loss and it's due to fire, a lot of these sublimits like jewelry and firearms don't apply because those are typically when you have theft. So again, you need to read the language of your contract and stop looking at it as a policy because you've got to know how to navigate around that language. I want to say it now and I'm going to say it again later. We are available to you, and I am more than happy to schedule as much time as you would like to talk about your individual situations. And I have some scheduled for this evening after this, because if you are trying to really position yourself and understand how to get over that finish line, your situation is going to be different than your neighbor's. So be careful about the information that you get. Be careful about where the advice is coming from. If they are not a licensed adjuster like myself or an attorney, I would encourage you to give that information the value it deserves. You've got to be careful because there's a lot of misinformation going around and you don't want to start making decisions based off the wrong information. You're going to hear a lot about ACV versus RCV, folks, and I want to go into that because a lot of people have a misunderstanding as to what replacement cost works as it relates to personal property. Actual cash value, folks, is what the insurance company owes you before you replace the item. And here's an example to that. If you have a couch and that couch is 5 years old and you spent $1,000 on that couch, as you're going through the list and what the insurance company is asking you to put together, which we're going to get into in just a second, you had let's say a restoration hardware couch and it was $1,000 and it was 5 years old. The insurance company will come back to you and say, Mr. and Mrs. Insured, thank you so much. We see that you bought a couch for $1,000 and it's 5 years old. Our database, being the insurance companies, they've got a magic database. The database says that this couch has a 10-year lifespan. And since you're 5 years into its 10-year lifespan, we're going to depreciate your couch by 50%. And we're going to give you $500 now towards the $1,000 that you paid for the couch. And when you show us a receipt that you have spent $1,000 to replace this couch, we will give you that depreciation that we are holding back to you. Well, folks, what if you decide not to replace all of those items? Who gets to keep that depreciation? The insurance company does. And it's all by design. They know statistically you are never going to replace 100% of what you've lost. So this takes me into this actual cash value versus replacement cost. Replacement cost means what it would take to replace an item in today's market. Not what you paid for it then, but what it would take for you to replace it now. So folks, as you're going through your list of the personal property, the last thing you want to do is to start going to wholesale and discount websites because you're trying to maximize your recovery and what it's going to take to replace the item. The carrier only owes you for the actual cash value, which remember is replacement cost minus depreciation equals actual cash value. So for most of you, the goal will be and should be, and if it isn't, I would encourage you to make it your goal. You want to work on your personal property until you are done. Do not give it to the carrier in spurts. Don't give it to them in pieces. You want to make sure that you have done your due diligence and that you have laid it out in its completion so that you understand what the dollar amount is that you're working with. So if you have, let's say in this example, a $500,000 policy limit, to put it in perspective, you must take into account the depreciation that they're going to apply. And I will tell you folks, across the board, they're going to apply a minimum of 35%. So that being the case, let's say in this particular example, you might need to come up with a $750,000 to $800,000 replacement cost valuation for all of your personal property combined, because by the time they apply that depreciation, folks, your goal should be that the actual cash value, remember, that's the dollar that they owe you before you replace your personal property. You want that actual cash value dollar to be at or just above your policy limit so that it forces the insurance company to cut you a check for policy limits. The reason you want to work on that so hard is because you want to try and stay away from the receipt game with the insurance company. You want to maximize your recovery. You want to stay away from the receipt game, and you don't want to be held hostage by their depreciation that they're holding back. So it's critically important that you understand how to properly prepare your personal property. And as a courtesy, folks, if you want to reach out after the fact, we have developed some products that we've prepared over the years because we've represented so many residential total losses with all these recent wildfires. We've put together a product that I'm happy to share with you if you just send an email in and request it. It's a whole house guide, which represents about 4,000 line items of things you typically find in a home. We've prepared this to help our clients jog their memories so that not only are you looking at items that you may have had, but it may also help jog your memory for associated items that you may have left off the list. So for example, if you had a computer and you said you had a computer, an associated line item might be the printer. And was that a cordless printer or did you have a cable? Because that cable has a cost. Did you have a wired mouse or a wireless mouse? Did you have batteries in that mouse? Did you have a wrist protector? Did you have a document holder? Did you have extra reams of paper for your printer? Did you have extra ink cartridges? All of these items, folks, they have a value, and you need to be forensic in your approach to how you approach your personal property. Let's get into some common inventory questions because these are going to be what you're asking now, I'm sure, of yourself. Do you need to list every item? Again, folks, that's on a case-by-case basis. Some of you may have incredibly high-end personal property, some of you not. Some of you may have a large volume of personal property, and some of you may not. We recommend always that you want to start at your biggest, most expensive items and work your way down, because what you're hopefully trying to avoid is to get into counting every fork, or getting into counting every napkin, or getting into counting every spice that was in your spice rack. And that's how forensically detailed, folks, we prepare our clients' personal property packages. It's what you're going to need to do as well. So if you have a policy limit of X and you can get 35 to 40 or 50% above that number by starting at your big items and working your way down, and you can get to that replacement cost without having to capture 3 or 4 or 5,000 line items, and you can get there in 1,000, then no, you don't need to list every item. What is holdback and how does it work? As I explained earlier, full replacement cost or full replacement value, whatever the depreciation is that is being held back by the insurance company, you are entitled to it. However, depreciation doesn't come into play and you're not reimbursed for that depreciation if your policy and your list reaches policy limits. So again, if you're preparing your product and you've done so and you've gotten so far above your policy limit and its replacement value that by the time they apply the depreciation, that actual cash value or ACV dollar is at or above policy limit, there is no more to get. Your policy limit is what they owe you, and that's it. And again, so how do I get my withheld depreciation? Basically, we've already discussed it. If you are not at your policy limit and you are replacing your personal property, you must submit your receipts to the insurance company for the different line items that you replace, and then they will issue you back that recoverable depreciation for those particular line items. It is important also, folks, and I'm going to also, if you ask or send an email, along with that whole house guide, I'm also happy to send you a sample of a product that we produce for our clients. And the reason I think it's important that you have this as well is because the carrier has very specific ways they want you to prepare your personal property because that's the way they want it. But you're not obligated, folks, to issue your personal property product in their format. Their format is the way they want it done, but there might be reasons why they want it done like that. I can tell you for a fact that a lot of you who are insured with State Farm may want you to use their online portal, which is a nightmare. It is not user-friendly, and they see what you're putting in there real time. So as you put a line item in a State Farm a non-user-friendly personal property template, if it triggers a red flag on their end because of its value, they will start researching that item to try to find the actual replacement cost for less at another location, whether it's wholesale sites or wherever they find their pricing. They're looking for a line item to represent a lower replacement cost than what you've submitted. So they're always trying to work against you. Remember, folks, the insurance company isn't here to be your friend, and they're not here to start cutting you big fat checks and hold your hand and skip down the beach throwing rose petals. This is a long, arduous battle, and you have to prove yourself every step of the way. And the reason, getting back to that the insurance company has you produce your personal property is because they know that you will leave statistically about 37% of your personal property off the list. First and foremost. So if you're leaving 37% of your personal property off the list, guess what? They don't have to pay. That's number one. Number two, It is such an emotionally taxing task. They know that at some point you're probably going to get so frustrated and you're just going to give up and say, I'm done. I can't do this anymore, which is why now it's going to take me to my next statement. They give you an advance, folks. You have to understand why you're getting the advance. Some of you got 30% of an advance. Some of you got 50% as an advance. But if you don't know what that means, I'm going to explain it now. The carrier is rolling the dice that you're going to take that advance and you're going to walk away. You're not going to finish your personal property product because it's going to be so taxing, so frustrating, and just so emotionally overwhelming to you that you say, forget it, because I don't want to put together this entire product. So I'm willing to take what they give me and I'm going to walk away from the rest. In some cases, folks, for some of you, that might represent quite a large number. And that means that the insurance company wins and you lose. For some of you, that advance might be more than what you may have had in your home, and you don't want to poke the bear because they've paid it and you don't have to prepare a personal property product. You might be ahead of the game. But you've got to be careful, folks. You have to understand what these advances mean. And I am more than happy to spend personal one-on-one time with each and every one of you to discuss your specific situation so you understand how to best prepare yourself as you move forward. Let's get into some inventory tips and tools that I think you'll find helpful. We always recommend, folks, that you keep a pad and pen with you at all times. Keep one in the car, keep one next to the nightstand. Because as you start to remember things, you want to make sure you have a pen there to get it out of your brain and get it onto paper. There is a way of how to retrain your brain to be more effective in how you approach your personal property. And I'll give you a simple example. Your mind's eye has a memory, and that memory is based off your pattern of how you come and go from your home. You typically come in the door one way, you have a certain way you walk through the home, how you enter into the kitchen, how you enter into your living room. So as you try to remember all your personal property and your mind's eye is helping you visualize the house, it's taking you down that scripted path that it remembers. So you have to change your perspective. And so we recommend do an aerial perspective drawing of your home. Draw the outline of your home from an aerial perspective, and then log every closet, every bedroom, every bathroom from an aerial perspective. And then as you're in a room, grid that room out into 4 equal sections. And so instead of you walking into a room and having everything jump out at you, and you're trying to have some sense of a system to capture all of those items, you train your brain to focus differently and you become much more forensically accurate in your approach. Example would be, instead of you jumping into the middle of the room, if you break that room into 4 equal segments, you go into one segment and you work clockwise in that one segment. And as you do so, you look up the wall and down the wall and across the floor. So now your brain is starting to focus on a specific section of that room instead of trying to take in the entire room. And I assure you folks, you will end up with far more line items on your personal property just by implementing that simple system of visualization because you'll be much more effective. Don't forget what's under the beds. Don't forget what was in the dressers. Remember, folks, even your hangers are personal property. Your light bulbs are personal property. So don't forget to count all of that because it all has a value. And your goal, again, get you way beyond your policy limits. This is the time to really leverage your relationships with your friends and your family. Everybody wants to help. The best way for them to help is to start looking at all of their photos. If you've ever had a Christmas, an Easter, a Thanksgiving, a birthday, any celebratory event at your home where friends and family gathered and everybody's taking pictures, do yourself a favor and have them start jumping into their photo albums and their iPhones and their smartphones and start pulling up the pictures. And then you may want to open up a Dropbox and then let them drop all of these photos from these events into the Dropbox. Why is that important? It's important, folks, because every picture has a different potential angle, and that picture has your personal property in the background. But it also has the finishes of your home in the background. It may have captured your cabinets. It may have captured your countertops. And so if you are attempting to manage these claims on your own, and if you're sitting down with your adjuster, it always helps to have some pictures of different viewpoints if you don't have any in hand, so that they understand the fit and the finish of what you may have had in your home. So photo documentation is key in preparing your claim and proving what you may have had. Next, let's just jump into loss of use. There's two types of coverages that most of you will see on your policy. One is ALE, additional living expenses, and some of you may also have what is called FRV, or fair rental value. All of these two apply to your housing, your temporary housing. There are so many options, folks, in approaching this particular coverage that I will not go into all of them because there are so many. And most of you are probably already housed in some form in a temporary location. I would encourage you to make sure that whatever it is that you're consuming per month will allow that coverage, if it is designated by a dollar amount, to last you at least 2 years, so that you have enough money to sustain you for the next 24 months in whatever your rental expenses are. That rental expense should also include, for your ALE, your furniture rental cost. Please keep in mind, folks, that you're also entitled to increased mileage, which sometimes the insurance company adjusters neglect to tell you. There is an app. It is called Mile IQ, MILEIQ. It is through, I have an Apple, so I don't know if it's Samsung related, but it is an app, folks, that you should download. And as soon as you get into your car, it starts logging your miles. And at the end of the day, you can swipe one direction for business and you can swipe the next direction for personal. You are entitled to whatever the rate is per mile above your normal travel. So if where you lived, it took you 15 miles to get to work, and now your temporary home is 10 miles further, so you're driving an extra 20 miles a day in your day-to-day back and forth, you're entitled to be reimbursed for those miles. And it might not add up to much, folks, but over the course of the next year, if it's another $1,000 or $2,500, it adds up, and you should be entitled to be paid that. You're also entitled to be paid for animal boarding. Now, let's talk about that for a minute. A lot of you are fortunate enough to be living with friends and family right now, and you are housing your pets with you, with your friends and family. Folks, your friends and family are entitled to be reimbursed for housing your pets, just like you would put them in a doggy hotel or a kitty hotel. If your temporary location, which is somebody else's home, and they are housing your pets, they are not only entitled to be paid monthly for whatever your expenses are for your loss of use, for your additional living expense, but they're also entitled to be reimbursed for housing your pets. I would encourage you to reach out to your local boarding facility, ask them what the going daily rate would be for your type of dog, your size dog, your dog's weight, and etc., and factor that into what they may be owed, because if they don't submit an invoice to the insurance company, then they don't get reimbursed. And I'm sure everybody who is staying with friends or family would like to have them reimbursed. And again, folks, your policy is going to be driven by time or money. You've got to make sure that you're using that money correctly. You've got to make sure it will last you for the amount of time that you are going to be displaced. Now, fair rental value is different, because if you have a fair rental value clause in your policy, what that means is that you would be entitled to be paid monthly for what your home would have rented for at the time of the fire. If you do have fair rental value, and if you have additional living expenses, whatever that dollar amount is that the insurance company has come up with, folks, it is important for you to understand what data points they're using to determine that dollar amount. Are you being fairly compensated? What are the comps that they're using to determine your monthly allowance? If you have a 1,800 or a 2,000 square foot home and there are no comps for them to pull from, so they're using a 1,500 square foot home that's 60 miles away, that does not count. You want to make sure they're being accurate in their overall assessment. So make sure if you don't believe that the dollar amount is fair, you have every right, folks, to push back. Remember, this is your claim. This is your contract. This is your money. You have a right to question, and I would encourage you to do so. Squeaky wheel gets the grease, as they say. The carrier also owes for increased costs due to limited housing. So if they come up with a dollar amount that they feel is fair for what your home would have rented for, but there's no inventory, then it's a moot point. So let's say you have a 2,000 square foot home, but the only thing available in a 15 or 20-mile radius is a 3,000 square foot home, and it would cost more to rent the 3,000 square foot home than it would for what they're allotting to your 2,000 square foot home. So be it. They're entitled to pay it, and it is what it is. So again, if you have any questions with that or you're having trouble with that, please, folks, reach out. We're here to give you guidance and advice. This isn't about hiring us. This isn't about representing families, and this isn't solicitation type of webinar. This is providing a resource for you to get accurate information for you to better present your position to the carrier. So if we can help you help yourself, fantastic. We want you to be successful in your recovery efforts. How do I ensure, let's go into the next, how do I ensure that you're not leaving money on the table? Well, first and foremost, folks, do not talk to the insurance company about your goals. It telegraphs your position. It lets them know what you're intending to do. And what it does is it allows them to take a strategic approach behind the scenes that you are unaware of in how they present their settlement to you. Remember, folks, there's a reason that you get advances and there's a reason you don't get your policy limits. The more money they can control behind the scenes, the more control and leverage they have over you. And their job is to drag you over the landmines that you don't even know exist because you don't understand how to navigate your contract. They do. You're at a disadvantage. You didn't write the contract you're in. Their attorneys did. And so they are going to follow suit with how they handle every single claim. Please don't think your claim is any different. It isn't. They're going to handle your claim the same they handle every claim because that is the business model of that particular insurance company. You're dealing with a business, folks. That's it. And you've got to simplify your position and understand what you're dealing with in order to best protect yourself. Meet with a claims consultant like ourselves. Talk to an attorney. We have extensive experience with attorneys. We typically have attorneys come to us for advice on how to manage their claim because the infrastructure that is required to prepare, present, and negotiate a claim. Attorneys are certainly an option, but this isn't a legal issue, folks. This is a valuation issue. It's how do you determine the value of your loss and then prove it through a defendable manner that supports your position. The common question is, do I rebuild? Well, folks, that again, that depends. And there's a lot of factors that go into that particular question. And I have lengthy conversations with people daily about this because sometimes it doesn't make sense. Many of you have made the mistake, not because you just didn't know what you didn't know and you were ill-informed, you paid your mortgage off. And if some of your mortgages were pretty high, the reality is that you just paid for the scorched earth that your home was on. And if your mortgage was more than what you would have typically paid for your land, you've just thrown money away. It is not advised to just pay your mortgage off because you may want to use that money to rebuild and leverage that money to regain as much money on the back end as you can, should you choose to sell the home down the road. But again, everybody's situation is different, and that's why we have one-on-one conversations to help you better identify a path for your goal. It's our job typically when we represent a client to identify the client's goal And then we identify how that contract is expected to respond to this goal. And then it's our job to prepare the strategy and then execute that game plan to achieve the client's goal. Well, the same falls on you folks. You have to figure out what your goal is and what your path for recovery is. So again, if you have a mortgage, that's going to play a role because the bank is going to have a say-so in what you do with their asset. They own the property, not you. So they will most likely want that property rebuilt. And again, they have a right to have their asset replaced, not necessarily to have the mortgage paid off. Code, does it transfer if you don't rebuild? Is that important and how might that affect your recovery? Yes, it does. It may or may not transfer. And if you don't rebuild, you certainly aren't going to have any code related coverage. But if you're purchasing a property or you're rebuilding elsewhere, you may be able to transfer that code related coverage to your new replacement property that you purchased and or one that you are intending to build. Should you buy instead? Folks, that's a personal question that only you can answer. And I think that it's only when you take a step back and you lay your numbers out in front of you and see what makes most fiscal sense for you. Everybody's situation is different. Some of you, it makes sense to purchase a home because you are way ahead of the game with your insurance settlement. Some of you, it may not make sense and it will require you to rebuild in order for you to regain some of the money that you may have lost in this event. So again, case by case, and it's specific to each and every one of you. If I buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? Folks, that's really a sticking point that you need to be aware of. Your claim is nothing more than one large negotiation. And as such, with every negotiation, it requires a format in which you must follow. But in order for you to understand how to prepare your narrative, you have to understand how your policy/contract is going to respond to that request. So again, it's why we offer for, consultation to kind of walk you through your process and give you things to consider. If you intend to rebuild, you must understand how to get the carrier committed to the monies up front. What I say by that, what I mean by that is this. Remember when we talked earlier, you have a stated limit of coverage A. That dollar amount, folks, is what the insurance company owes you up to. That's not what they owe you. That's what they owe you up to if you prove you are entitled to that money. If you exceed that in the way that your loss is measured on paper, it will unlock that extension we discussed, your extended replacement cost endorsement. But remember, you don't get that as a check in your hand. So it's critical that you have a conversation with your adjuster and the insurance company, because if you intend to purchase another property, and if you are going to need that additional coverage amount in order for you to achieve the purchase goal, you must get in writing from your insurance company how they intend to release that extended replacement cost money towards your purchase. You've got to get it in writing. You've got to get them committed to it. And if that is your intent and you don't have a mortgage and you're free to do what you choose with your money, I'm telling you, folks, get it in writing. In fact, get everything in writing. Do not communicate with your adjuster via text. It does not make it into your claims file. Do not have a conversation on the phone with your adjuster unless you memorialize that conversation for multiple reasons, folks. Your adjuster does not have the authority to make any financial commitments to you. It is not their job. Management is who makes those commitments. Your adjuster's job is to gather data like a drone, send that information up to management. Management then reviews your file, makes whatever changes they want to make, gives it back to the adjuster, and then the adjuster offers it to you. If your adjuster has made any financial commitments to you, be wary of the follow-through. because again, they just don't have the ability to make those commitments to you. So if a commitment is made, you want to recap that conversation in an email so that you have record of that conversation, which makes it into your claims file, because you will probably have several adjusters throughout the course of your claim. And if the second adjuster that is reassigned to you doesn't see a commitment made by the first adjuster, and you're telling the second adjuster, hey, where's my $500,000 check that, adjuster A had promised me, and adjuster B looks in your file and there's no notes and there's no documentation to support that conversation, it never existed. And you have to start that process all over again. So only email with your adjuster. Make sure you ask them to email with you, and make sure that if you have a phone conversation, folks, you're memorializing that conversation in an email to capture that discussion so that those commitments are covered. Let's go ahead and move forward with what risks, or actually, who can represent you. So in the state of California, folks, the only two entities that can actually represent you in the negotiation of the settlement of a claim is an attorney, which again, I discussed earlier. This is not a legal issue, folks. This is a valuation issue. So if you are communicating with attorneys, make sure their path of your recovery is crystal clear, and make sure that it makes fiscal sense for you to do so. Because you have to prepare your entire product, the estimate for your house, the personal property product for your personal property. You need to understand how they intend to do that. And every attorney is a little bit different. Public adjusters, which is myself, we are FBI, Department of Justice background check. Our licensing is issued through the Department of Insurance, and actually the insurance commissioner for the state of California is who issues our license. Who is not allowed to represent you in a claim is a contractor, an insurance agent, or a broker. So I say this to you folks with all due respect. If you have a relationship with your agent or your broker, please do not rely too heavily on them to represent you in this process, because although the Department of Insurance is the same governmental entity that gives your agent or broker their license is to sell you the product. The same department which issues our license to negotiate the settlement of that product. Just like I cannot sell you the policy, they cannot negotiate the settlement of a claim. It takes a very specific license to do so. Contractors will try to inject themselves in between you and the insurance company because they want to know how much money you're getting from the insurance company so that they can consume that money. It's always ironic to me that when you have a settlement of, let's say, $476,000, the estimate from your contractor is $476,000. So it's always a good idea, folks, to keep some separation between you and what you're getting paid and others who are wanting to consume that money. And even as you move forward and you hire a contractor, should you choose to rebuild, folks, make sure that you are involved in the communication. Never let the contractor communicate directly with the bank without you being on that signature triangle. You must make sure that you are endorsing every check that goes to that contractor, and that you're not giving the contractor the carte blanche to just communicate with your insurance adjuster and invoice and send their invoices to the insurance adjuster directly, and or communicate with your bank directly, because what's happening effectively is they're cutting you out of that communication. And if you are not satisfied with their work, you would normally have the ability to hold a check back and hold that as leverage until you were satisfied with whatever it was you were unhappy with. You remove that ability if you allow them to communicate directly with your adjuster or directly with the bank, because as soon as they submit that invoice and they get paid, you have no control in that scenario. Now I'd like to kind of jump into some of the questions that I see that have rolled up. Again, here's my contact information, folks. Please feel free. That's my cell number. Reach out anytime. I'm happy to take as much time as you'd like. It's just a service we provide. It's part of our moral and professional obligation to spend the time with you folks, give you advice, give you guidance, And only if you feel that this is going to be beyond you and you have all of the data in front of you to make an informed, educated decision, and you think representation might be something for you, that is a completely different discussion down the road, folks. I'll have that privately should you choose, but I want you to know you can reach out to us anytime. So some of the questions that I'm seeing here, the first one is, what's the best way to prove the value of what I've lost when doing my personal property? Excellent question, and I'll explain what we do, and I would encourage you to do the same. As our team is doing the research for all of the line items that we prepare for a client, we also go online and we find that item or an item that is as close as we can get to that item. And once we find the location that is issuing our replacement value, whatever website that is, I encourage you folks to screenshot that and print it and attach that screenshot to your personal property product. And the reason I'm asking you to reach out and ask us for a sample is because I want you to see how we prepare a personal property for a client so you can follow the same format. Our firm is well known for the personal property product that we produce for clients. It's incredibly detailed. It takes all the power away from the insurance company because we're proving the value of every line item. So when you screenshot that item that you have found and you print it and you submit it with your personal property, that screenshot becomes an exhibit to support that line item's value. Because remember, you have to prove to them the value of what you've lost, and you can't just pull numbers out of the sky. You've got to show them something that proves the value of the replacement cost that you are placing on your personal property list. Next question, can you talk more about the advance and the strategy behind that on the insurance company side? Absolutely. So remember, folks, you're dealing with a business, and as such, they have a business model that best represents their financial interest and their position, not yours. It's a business. They have shareholders to answer to. They have, just like any other business, profit and loss. The insurance companies, in order to control their loss, folks, they can't control if somebody cancels a policy. Well, that's a loss to them, right? They're no longer generating revenue. They can't control that. What they can control is what they pay on a claim. And so typically insurance companies have a formula and they will pay X amount of pennies on the dollar that best represent their business model. Everyone's different, so I'll be vague in that answer. However, the reason you get the advance is because now you have to prove to them that you're entitled to more. But because you're outgunned and because you are at a major disadvantage because you don't understand how to navigate the contract you're in, they have the upper hand. And if you can't prove to them that you are entitled to more, their guess is they're only going to increase what they owe you by a very small percentage, which is why they give you an advance. Typically, if it's 50%, you have to remember, folks, you're not only 50% away from your policy limit, but if you have an extended replacement cost endorsement of, let's say, 20%, the reality is you're 70% away from your policy limit. That is a huge gap to get the insurance company to bridge in order for you to get your money. Same thing with your personal property, folks. If they give you an advance against your personal property, their hope is you're going to take that money, and when that project that they have you do becomes so overwhelming that you finally say, forget it, I'm done, I'm out. They're hoping you walk away so that you just take the advance. And again, if you've gotten a 30% advance, they save 70%. So a penny saved is a penny earned in this industry. Do not give up on your personal property. I'm going to give you a different way to look at it. If I were to say to each and every one of you, and we'll just say you had 300,000 in coverage, just as a general number, and I were to say, Mr. and Mrs. Insured, if you wouldn't mind working for me for 2 hours a night, 5 nights a week, take the weekends off. I just need 2 hours a night, 5 nights a week for a month. And if you do that, I will pay you $300,000. That, folks, is how you have to look at your personal property, because the more time and energy and effort you put into that, you're paying yourself to do so. If you give up, you're leaving money on the table. It's a daunting task, yes, but if you do it in bite-sized pieces, a couple hours a night, or even an hour a night, and you cut it off at that time so that you're not overwhelmed, it will be easier for you to get through that task. Let's see. What happens if my personal property dollars are less than my advance? That's a great question. That's why it's critical for you to not do your inventory in bits and pieces, because as you do, they are adding that up real time. And it would not surprise me. Of course, I've seen this, folks, where the carrier comes back and says, hey, we overpaid you. You owe us X back because of what you just submitted for your personal property. So you want to do your personal property offline. You want to price that personal property privately. You want to make sure you understand what your replacement cost is that you're getting ready to submit. And if you believe that after that depreciation is applied, folks, that your advance is going to be more than what you're submitting, you may be in a bad position. That's why you don't want to do what they ask real time, because they are trying to monitor if the advance they gave you was accurate or not. So again, do it offline, be private about it, and you want to make sure you're submitting only when you know you have exceeded in your replacement cost value so far above the advance that you know that no matter what, you're not going to go below the advance. Because remember, the advance, folks, means this. You have to justify the advance before you get a dollar more. So your inventory that you're preparing and submitting to the insurance company first has to justify the advance before they give you a penny more. It doesn't start from where the advance left off moving forward. You have to justify that. So again, most of you will exceed your advance, but it's important that you do it in a controlled fashion. Next question. What are the pros and cons of letting the insurance company write my estimate? Well, that's like saying, that's a great question. That's like saying, what are the pros and cons of letting the IRS do your taxes, folks? Seriously, it's the same thing. They're looking out for themselves. And again, you have to challenge their position. The con is that they are an employee or a third-party vendor that's been hired by the insurance company to do a specific function. They're not there to represent you. They're there to represent the insurance company. And no matter what they say, no matter how nice they are, and I'll even use the State Farm commercials that you see in tornadic events where that adjuster's putting their arm around you and they're hugging you. Folks, they spent millions of dollars on their advertising campaigns for you to trust them. They are not looking out for you. They are looking out for them. So be aware. You do not want them to prepare your financial recovery. Because remember, folks, your entire financial recovery is solely dependent. I'm going to say that again. Your entire financial recovery is solely dependent on that one adjuster's interpretation of your loss as they interpret what you have told them. So if that person is new, if that person is inexperienced, if that person is from out of state and they're trying to recreate California reconstruction costs and they don't live here and they live somewhere in the Midwest, and $1 million home here is a $250,000 home there, they're not going to get it. And there's a very specific software, which I won't get into in this because it's super confusing, but understand, folks, there's a software system that the insurance adjuster uses. It's what we use. It's what is used in the industry. It's called Xactimate, but that template and that software is only as good as who's inputting the data, and that's it. So understand that's a risk that you take. Next question, what do I do if I don't agree with the number the insurance company comes up with? That's a great question, folks, because you're probably not going to agree with it. So the question is, what do? You have to prove to them that they are wrong in their language. And that's where they get you, folks, because you don't speak the language. So the more you understand your policy, The more you understand how that contract responds, the more you understand your rights, and the more you understand what you're entitled to, will better prepare you for your position that you take against your insurance company. Now, many of them will say, well, listen, just go get us an estimate from a contractor, and if we're entitled to pay you more, we'll address it as we go. Okay. Well, how are you expected to enter into a contract with a contractor if you don't even have a negotiated budget from the insurance company because you don't know the number that you're working with to enter into a contract with? How are you going to know what to build if you don't even know how much money you're getting? So it really is a strategic position on behalf of the carrier to not pay you limits. It's by design. They want to control the second half of that money. And as soon as they paid you that advance, folks, against your structure, your clock is ticking and they will expect you to start performing because your housing is directly related to that advance. As soon as they gave that to you, they are expecting you to start moving your claim forward. Drawings, engineering, design, architecture, all of the things that you need, they expect you to start doing so. And your housing is directly related to time. So many of you may have gotten an advance against your housing. They may have given you 3 months. They may have given you 6 months in advance, or maybe you got no advance, but they're paying monthly on your rental. At some point, folks, they are going to come back to you and they're going to ask where you're at in your process. And if you don't have a legitimate response, they have every right to pull that funding for your housing and really start to put you in a financial situation. So again, if you want to talk strategy offline, there's a lot of different ways to position yourself. And I encourage you, if you're having trouble with any housing or you have questions about housing, please give me a call because I can give you some insight into that. Last question here that I see, and these have been great questions, folks, and I appreciate them very much. What do most people do in situations like these if they intend to rebuild? That's a great question. What most people do is they get the advice of a professional to understand how to better position themselves so that you know how to personally maximize your recovery. Folks, this is a strategy. This is a long game. This isn't a sprint. This is a marathon. And you have to know how to strategically put those chess pieces on the board to achieve the checkmate. And I cannot stress enough, if you just go into this thing blindly or you go into this trusting your insurance company because they've been so nice to you and cooperative and they've given you checks right away, watch what happens over the next 2 or 3 months and see how nice the adjusters are or how quickly they start responding when you send an email. It's gonna fall on deaf ears. Your response time is going to start to slow down if they respond at all, and your frustration level is going to ramp up. So the better prepared you are in the beginning and have a game plan and a strategy and understand how to execute that strategy, the better prepared you will be in going to battle with the insurance company. So with that, it looks like that's all the questions, folks. I can't thank you enough. I appreciate your time. I hope you've gotten a little something out of this. Again, this is the last of the webinars. So if you have specific questions, please feel free to give me a call. I'm more than happy to spend whatever time you'd like. It is just our way of giving back to the community so that you can help yourself. And again, if you want any of those products, please feel free to reach out. And I am more than happy to make sure that you receive those whole house guides and the sample personal property product so that you have some kind of format to follow. I wish you all the greatest in success in your claim. And again, I'm sorry that we had to have these types of webinars and we meet under these conditions. But again, we're a resource for you. Please reach out anytime. Wish you all the best and wishing you many blessings in your recovery to come. Thanks so much, folks. Take care.